before I actually dive into the financial statements itself, I just want to set some context around, what defines a balanced performance, because this is not, we have entrepreneurs over here. What you're really interested is not really accounting, but it's more about how you use data, how do you view the data, and how can it actually improve your business. That's what you're really looking out for. And in my several years with large organizations like Dell, Apple, etc., that's one of the things we have always been focused on: business balanced business performance. So it's very critical. Oops. Are you able to see me? It suddenly became dark over here.
Yeah,
Yeah, we
still.
can still see you.
Yeah.
Oh, okay, fine. So, so when we say balanced business performance, we are looking at three sides of the triangle. This is something that no entrepreneur should actually lose sight of. One is the growth, the second piece is the liquidity, and the third piece is the profitability. Now, it's, as you all know, many of you are experienced entrepreneurs. Having growth, but without liquidity, when we say liquidity, means having ready cash in hand to carry out various activities or to make investments, etc. So having growth without liquidity and profitability is a problem in itself, because if you don't have liquidity, then you're going to sooner or later run out of cash, and that's going to bring a lot of issues along with it. If it is not profitable, then the very core of your philosophy of running the business is in trouble. Likewise, you have liquidity, which means you have cash, but you're not a profitable business. That is a problem in itself. If you don't have growth, then very clearly, days are numbered. Likewise, you have profitability, but you don't have growth or liquidity. That means that, you are being, basically you're able to capture the margins, but you're not able to grow the business, or you don't have cash. That also is a problem. So that's where a balanced performance really becomes really critical. And the reason I'm laying it out in context is, uh, I would urge all of you to keep this in mind as we go through the financial statements, because the financial statements are intended to provide you those insights which will help you in deciding whether your business is having a balanced performance or not. So with that in mind, I'll move to the next slide. So for a minute, I will not talk too much about the ratios that you see in the boxes of growth, liquidity, and profitability. We will cover that in greater detail when we come to the session 2, where we'll talk about ratio analysis. We'll cover that in greater detail. Now, the second piece, as as entrepreneurs, when you run your business, there are a few key things that you as an organization would like to keep in mind. One is timely and accurate accounting and compliance. When I say timely, it means every month, end of the month, within a week to 10 days time or so, you should have the financial results in place, because you're running a business. You need to know whether your company did well during the month, did not do well, what went right, what went wrong, etc. And obviously compliance, so that you don't get into trouble with the authorities. So very clearly, very fundamental and extremely important, because if this is the base of this whole function, if this doesn't happen, then you can't rely on the numbers and you won't know where you're headed. Then comes the financial statements and metrics. So when we say financial statements, we are basically talking about three key financial statements, which we will cover in greater detail: P&L, balance sheet, and the cash flow. And along with that, the metrics that are really critical for the business. Planning and goal setting is another important piece. In my experience with a number of startups and SMEs, what I've found is this is one area that is somewhat neglected. Most people have some view of their profitability, etc., and to some extent do some level of accounting. Even there, I've found it somewhat lacking in many companies. They often they tend to see the financial statements at the end of the year just for the audit purpose. But actually, I would strongly recommend that the team actually reviews the numbers on a monthly basis at least. Then comes the planning and tracking of the metrics. So planning is one thing. Whatever goals have been set, are we tracking to the goals? Is it happening? Is it happening? Not happening? If it is not happening, why is it not happening? What are we going to do about it? Those are some of the questions that the leaders should be asking to make sure that their business is on target. Then comes the cash flow management. This is another area where I see really a lot of scope for improvement in the Indian SME space, because very often I have found that in my experience that a lot of good businesses out there waiting to be taken. They are fully plugged into the market, but there are a number of instances where I've seen, and leaders have spoken to me and said, hey, you know what, I can go get the business, but I don't have the money for it. So basically what is happening is you're leaving business on the table and not actually able to take it because cash flow management is kind of lacking, and that causes issues in terms of growth. The last piece directly connected with the cash flow management is the securing timely funding. So managing the internal cash flow as well as ensuring there is sufficient funds for growth is also equally important to make sure that the business grows at a rapid clip. So these two slides, I just wanted to set the context. Now, with this in mind, I would quickly want to go to the financial statement. So I'll start with the profit and loss account. I'm sure all of you have come across the P&L. All of you are entrepreneurs. I'm sure you have your P&L and you are looking at the results of your business. Fundamentally speaking, income statement is basically a statement that provides the results of your operations. That means so basically you're in the business of buying and selling and manufacturing, etc. What is the result of those transactions or activities that have been done during a certain period? And it's very important to note, when we talk about P&L, we are actually talking about a statement that is for a certain period of time. So that means when we say it's a profit and loss statement, it could be for a month, or it could be for a quarter, or it could be for the year, whatever that period is, but it is for a certain period in time. Then we have the balance sheet. The balance sheet is the financial position or condition at a certain date. There is a difference. Just to recap, the first one, the P&L is for a period of time. So if it is, let's say, for a year, so it is for a 1 year period statement that you're looking at. The balance sheet is a little different. It is as of a particular date. And what do we mean by that? When we say as of a particular date, what we are actually meaning is, in this case, what really happens in the case of balance sheet is it is an accumulation of all the transactions that have happened not only during the current year, but over the previous year and the year before that, right from the beginning and the inception of the company. So the balance sheet actually summarizes literally the transactions and shows it the way it stands today. So that is how it is a little different. It is as of a particular day in time and it is a cumulative statement of all that has happened over the last several years from inception. The third piece is the cash flow statement. The cash flow statement is basically it's a statement that shows the movement in cash transactions, and it basically shows how much is the cash inflow, the cash outflow, what is the opening balance, closing balance, etc., and kind of gives us explanation of how money has moved over a certain period of time. So this is a quick snapshot of what these three statements are about. Now let's dig a little deeper into the income statement, which is income statement is also called the profit and loss account. It's kind of used interchangeably. So it's a reporting of success or failure of a period, in the sense that it says whether you made a profit or a loss. It summarizes the revenues and expenses. As I mentioned earlier, it'll be for a period in time. So it could be a month or a quarter or a year. And what it actually shows at the end of it is the net profit or the loss. And also you will note that the P&L is typically drawn on the basis of the accrual system of accounting. So just to give a quick example of what an income statement looks like, by and large, it will be very similar to what you have seen in your organizations. P&L, most people have found know what a P&L is, so I don't really need to talk too much about it. So you have the sales to start with, then the cost of sales, which basically means the cost incurred in the factory in terms of both raw material, labor, etc. And the net of all, and what gets consumed, what material gets consumed in order to create that product which you are actually selling. So there is a matching concept. So if you are doing a sale, then there has to be a matching cost associated with it that we book. So that is the cost of goods sold. So with that, we get the gross margin, gross revenue. So sales less cost of goods sold is the net revenue, or you could say the gross margin. And that as a percentage of revenue kind of tells you what the gross margin looks like. But that is before all the other expenses, office expenses and non-factory related expenses that we have. So that comes below that. And you can see for yourself, rent, depreciation, salaries, etc., interest, all that put together, the net income is basically the profit and loss. So this is a very simple profit and loss account. I'm sure most of you are already familiar. You probably need no introduction to this. But having said that, I just want to briefly pause to find out if anybody has any questions before I quickly move to the balance sheet. Any questions from the participants here?
Please feel free to unmute yourself and ask a question, or you can also use the chat box to ask questions. In case there are no questions, then we can move on.
Okay, so looks like most people are familiar. This is very basic, so probably needs no further explanation. I think more explanation is actually required possibly for the balance sheet, because that's where I find a little bit of lack of attention, if I may, that I've noticed in most of the companies.
We have two questions which have come
Sure,
up.
sure.
One is, he says, please explain quick ratio and also explain asset ratio. Is that something that we're coming to a little later?
So that we are covering in the next session, but quick ratio is basically, just since you have asked, I will quickly give a very quick answer. Quick ratio is it is a measure of liquidity, basically to determine how much cash is readily available with you to meet the expenses. So it is current assets. When we say current assets by current liabilities, that's typically the current ratio. But here, when we say a quick ratio, we actually, when we take current assets, typically we have accounts receivable, inventory, and all those things. But we will consider only those that can be converted into cash within a short period of time, maybe 1 year or so. Because if you have assets which will not get converted to cash within a short period of time, that is not quick enough. So by definition, quick means can be quickly converted to cash. It is either cash or can be quickly converted to cash. So quick ratio is the quick assets divided by the liabilities, so that kind of tells you if you have sufficient quick assets to meet the liabilities, then it means that if there is an issue at some point of time and you are running short of cash, if you find that your quick ratio is good, which is definitely above 1, that means you are able to meet 100% of your liabilities, then you are in good shape. But if your quick ratio is lower, then obviously you have a bit of a challenge over there, because you may not be able to meet all your liabilities if it comes up. So that's on the quick ratio. Then you have the assets ratio. Typically, we call it an asset turnover ratio, not so much asset ratio. But if you actually meant asset turnover ratio, then it's basically assets divided by sales, or you could do it the reverse way as well. It basically tells how quickly, how efficiently your assets are being utilized to generate revenue. The higher that ratio, that means you are able to turn around more and more sales. Let's say it's sales divided by assets. Then the higher the ratio, the better. That means you are with the same assets, you are able to generate revenue faster and faster. And as you generate more and more revenue quickly, that means you are more and more productive, and therefore you are going to generate more profits much faster. So that's a quick snapshot of these two ratios that you asked about.
Thanks, Shikhar. Shikhar, we have another question from Nikhil, who says stocks opening and closing in P&L. What does that mean?
So here is the thing. So you see the cost of goods sold over there, right? You see 97,667. If you see my pointer, so that is the cost of production. The cost of production means what? How do you produce products? It has to come out of inventory. That means you're purchasing some material and you're stocking it somewhere. And depending on what you want to sell, you will actually withdraw that material from your inventory that you have purchased and put it into the factory for production. So if you see the inventory movement, you have the opening inventory during that period, whatever that period is. So you have the opening inventory. Opening inventory, then if you purchase additional items, then your inventory increases. So you will add inventory to the opening inventory. So if your opening inventory was, let's say, 100, you bought another 25, which is purchases. So your inventory became 125. But for the purposes of production, out of the 125, you consumed only 50. So out of 125, if you take out 50 went into production. That 50 represents that 97,667, because that got produced to generate that sale of 244,167. So opening balance plus additions, that means additional purchases, minus consumption, which is issued to production. So opening stock plus additional purchases minus consumption, which actually went into production, is your closing stock. So that is what is maintained. So you basically maintain an inventory register for that purpose to keep track of how much inventory is available with you for issuing to production at a later date. I hope that answers your question, but that will probably come up again when we talk about in the balance sheet.
Thank you, Shekhar.
Okay, so with that, very quickly, I will move over to the balance sheet. So here is a sample balance sheet, if you can see. So the first one, if you can see, is the assets. So the balance sheet contains two sections in it, primarily. The first one, let's say, is the assets. The second one, so in the assets, so what do we mean by assets? So there are different types of assets that we are talking about. So there are current assets and there are fixed assets, etc. Non-current assets. So current assets are typically what, as you can see over there, if you see current assets are which are very current, which can be converted into cash in a reasonably quick period of time. Not very quick, but a reasonable period of time it can be converted. It's not like land. Land takes a very long time to convert to cash. If you have to sell land, it may take you a year or 2 years, or you never know. Or machinery. How do you sell machinery? It's going to take time. So that's not a current asset. Current assets is what you have actual cash in hand or cash in the bank, because that's all real cash actually sitting there, current asset. Accounts receivable also is a current asset, because accounts receivable is your debtors, as you call it. Debtors is if you go collect the money, that becomes cash. So that also is a current asset. Prepaid expenses is treated as a current asset because you have already paid it. So it is almost like the money is already paid, so it's like an asset. So if, for example, you are paid rent in advance. The reason why you call it an asset is though the money has been spent, now you are going to get the service and you don't have to spend again. So that service is available to you. It is almost like cash. It is almost like cash because you don't have to spend the money. So it is available to you as a service. So those are the examples of current assets, and non-current assets are fixed assets. So your machinery, equipment, all those things. And the way it is represented is, you would have heard of depreciation as well. Depreciation is the cost of wear and tear of machinery. So in order to reflect the true state of affairs of the finances and assets, a certain depreciation is applied to all the machinery, because from the time it is purchased, it is depreciating over time, and it will not, if you go and sell it, you will not get the price that you paid for when you actually purchased it. So to reflect the true value of that machinery, you actually depreciate it. So the accumulated depreciation from inception of the purchase of the equipment is what gets captured here, and the net amount is shown as the value of the equipment. So the total assets is basically the current assets plus the non-current assets. So non-current assets could also include equipment, machinery. It could also include land. It could have property, building, all those things. So that is also included. The next piece is, the next section in the balance sheet is the liabilities and equity. So liabilities and equity is basically, as you can see over there, current liability. So just like current assets you have current liability. Current liabilities basically means there are certain amounts that are payable. That means you are liable. That means there is an obligation for you to pay somebody. So you have accounts payable, some certain taxes, you have withheld taxes, TDS and things like that. That has to be paid. So you have collected some money, it has to be paid. So that's a liability. There is an obligation for you to pay. You have to pay taxes. Accounts payable, that means you have purchased either raw material or assets or anything like that. So if there is a liability to pay, that is accounts payable. So that's also a current liability. So like that. So here FICA and medical care are typically US terms. So ignore that for the time being. But those are kind of, they are also a kind of tax applied by the government. So we have current liabilities. Sum of all that is the current liabilities. Then on top of that, we have non-current liabilities also. Non-current liabilities, where we call it notes payable, but it could be, for example, long-term loans. So long-term loans, if you have taken some loans for capital loans for machinery, term loans, etc., that will show up over here, whatever money you have taken from the bank. Likewise, in the current liabilities, if you have taken some working capital loan, etc., which is a short-term loan because you are expected to repay on an ongoing basis, that also is considered under current liabilities. Then comes the
We have
equity.
two questions here, if I can interrupt
Sure,
you.
sure. Yeah.
So Shreya says, what about inventories and what is deferred revenue? So is that something that you would want to take now? Or would you want to come to this question?
Yeah. I think this representation has missed out on inventory. So inventory will come under current assets, just like accounts receivable. You will have. It's a good question. So good you pointed out. Inventory also should be part of the current assets. In this example, it's not there, but inventory is also a current asset because, and the reason it's a current asset because inventory can be, you can use the inventory to manufacture and sell it and get the cash. So that's why it's a current asset. So deferred revenue, let me give you an example of deferred revenue. Deferred revenue is basically sometimes what happens in, for example, in software companies, you will invoice a customer and you may get the money for the entire contract, which is for the full year. You receive the money today, but you have not rendered the service. So you have received the entire money for the entire contract, but you still have 11 months to go. You have to, the money has come in, but you still have 11 months of service to provide. To accurately reflect that position in the balance sheet, the accounting methodology that is used is, it is only 1 month will be captured in your profit and loss account. The balance 11 months will be parked in deferred revenue in the balance sheet, and every month, a portion of that will get tagged into the P&L. So deferred revenue will slowly keep coming down, and by the end of the year, the entire amount would have been used up. So I gave you a simplistic example. Here, I assume that every month a certain amount will come. But actually, in real life, it could work a little differently because companies may have contracts which are based on milestones. So it may not be every month kind of scenario. It could be more like you achieve a certain milestone, then you can book the revenue because there is customer acceptance for that. So if the milestone is out of a 10 lakh total revenue for the entire year or for the entire contract, if one milestone has been achieved, let's say the milestone is for 3 lakhs, when you achieve the milestone, you book the 3 lakhs, which means you park it, you take it out of deferred revenue and book it into the P&L and charge it as revenue, because that is the real earning. The rest of it has not yet been earned. So that's the explanation for deferred revenue.
Thanks for that clarification, Shikhar.
Okay. So let me quickly go to equity. Equity basically, you all know it is owner's equity. It could be in the form of shares, or it could be, partners may have, if it's a limited liability partnership, partners would have put in some money. But essentially, it is owner's funds that we are calling equity. The way that operates is, first of all, you get what is put by the owners in terms of capital. That is the owner's equity. Then every year, now you see the box over here, net income transferred from the income statement. So what happens? In the previous slide we saw, let me just go back there. In the previous slide we saw this thing, right? Your net income. Now that net income is what gets added here. This 22,484 that you see over here is the net income from the P&L. So basically the sum effect of all the transactions that happened in your P&L resulted in a net profit of 22,484. That 22,484 is what gets reflected. In other words, we call it reserves and surplus. In India, we call it reserves and surplus under equity. So it gets added to the reserves and is treated as equity because, and why is it treated as equity? Because it is the owner's money, right? So whatever is earned during the year from the transactions, whatever is earned, that gets added to the owner's equity because it has enhanced the value of the owner's equity. So sum total of that is the liabilities and equity is the box that you see over here. And if you see the balance sheet, the total assets will always be equal to the total liabilities and equity. So it is always balancing. It's only the contours of that will keep changing as the business progresses. But at any point of time, the liabilities and equity will always be equal to the assets. So I will pause here a bit and I want to see if there are any, or let me do one thing. I think I should finish off this particular slide as well. So let me just explain what is the connection between the P&L and the balance sheet. I'm sure some of you may have this question. How are the two connected? Where does it, what does it mean? How do I read a P&L and how do I read a balance sheet? So the income statement is the P&L. So how is the P&L actually impacting the balance sheet? You look at sales and revenue. Whenever you do a sale, what happens? The two things happen. Either you get cash straight away or you get receivables straight away. One of the two, right? So if you get cash, then there is no debtor involved. But if you have debtors or account receivables, you can call it interchangeably. If you have accounts receivable, at some point it will get converted to cash. But the fact is that every time you have a sales transaction, in the balance sheet, these are the two, cash or accounts receivable, one of these two will get impacted. So that is the impact of that particular transaction on the balance sheet. Likewise, all the items in the P&L or income statement will have some effect or the other on the balance sheet. So cost of goods sold will have an impact on the inventory because the moment it goes to the, as I explained to you a little while back, opening stock, purchases, less consumption is closing stock. This is the consumption. So moment you do a consumption, your stock comes down, your inventory comes down. That's how it impacts your inventory in the balance sheet. Then likewise, when you make purchases, it has a different kind of impact on the balance sheet. Your accounts payable goes up because when you purchase on credit terms, you will pay later. So your payable will, since you are not paying in cash, if you pay in cash, your cash will come down. But if you are putting it as a credit, then that means it will show up in accounts payable. So it will show up in the balance sheet as payable at a later date. Depreciation, I already explained to you earlier. Amortization is more about, let's say you have intangible assets like goodwill. when you purchase a certain company, sometimes you pay a goodwill amount for the goodwill is basically an association of the value of the company. So you pay a goodwill amount. The goodwill over time it gets depreciated, and the way the depreciation is reflected in the P&L and balance sheet is through amortization. It is another form of depreciation. So the intangible asset will come down in value, and it will get charged to that extent. It will get charged to the P&L. Then you have interest expenses, etc. And there again, it impacts notes payable. These are different types of payables. So that gets impacted. At the end of it, when you have net income, that is, the net income is basically the profit or the loss. As I explained to you in the previous slide, that gets added to the owner's equity. So that is how the income statement gets connected to the balance sheet. So at this point, I would like to pause and see if there are some questions, and I would be happy to answer.
There is one question from Nikhil. What is owner's equity, invested capital?
So owner's equity is basically, let's say you are, okay, let's assume you are a salaried professional today. Today you are earning a salary. Tomorrow you decide, I want to start my own company. How will you start your own company? You have to put in money first, right? You put in money, only then you can pay for the expenses. That putting your own personal money into the company is called owner's equity. There is a difference between owner and the company. You as an equity shareholder is different from the company. You may find it a little odd to kind of comprehend this, but the business and the individual are considered separate. So the transaction is recorded in such a way that when you put money into the company is treated as a separate entity, of which obviously you are a shareholder. But the way it is interpreted is, since you put money in the company, whatever money you have put in the company belongs to you, and that is called owner's equity, and it is a liability for the company because that company owes you that money. In case you leave the company, they owe you that money because that is your money. But obviously, if you have made losses after that in the company, that money will go away. But that is the interpretation of that. So it's a business and individuals are considered separate. Even if the company belongs to you, you are considered separate. That identity is different. And that's why it is called owner's equity.
Thanks, Shikhar.
I hope that was clear. Yeah.
And Shikhar, what would be notes payable?
So notes payable, etc. It could be some financial instruments, etc. So any interest expense that is payable on those financial instruments, that becomes a notes payable. Interest on notes payable. Yeah.
Thank you for that.
So there may be certain borrowings. It could be commercial paper, etc., where they have borrowed money from the public or something like that. So that becomes kind of like a liability. It's a notes payable. It's kind of like a borrowing. And the interest on that, because when you take a borrowing, you have to pay interest, right? To whoever you have borrowed it from. That borrowing is called notes payable. And that has an impact on the P&L because interest is payable on that. Nobody is going to give money free. But of course, if they give money free, then there is no interest. Yeah.
Thank you. Are there any more questions or should we move ahead? If there are, please put it on your chat box. Doesn't look like we have any more questions, Shikhar. We can move forward.
Okay, I'll move ahead. Yeah. So with that, I'll move to the last piece for today's discussion, which is the cash flow statement. So what is a cash flow statement? Cash flow statement basically provides information of the cash movement. Now, I want to spend a few minutes on this because people will wonder then what is P&L? P&L also was supposed to show something, profit, loss. When you are saying cash, what is this whole thing? So the P&L, as I had mentioned earlier, uses the accrual method of accounting. The accrual method of accounting basically means there are two things to it. One is accrual method of accounting, and also the P&L also includes non-cash transactions. That means, let me explain that. When you sell your product, you will either collect cash immediately or you will have credit, so you will show it as accounts. You will provide credit, so you will show it as accounts receivable. See, if you get cash, it's a pure cash transaction. So that is considered in the P&L, yes, because that is a sale and cost of goods, all that comes into it. Now, it also takes into account a non-cash transaction, which is where you are giving a credit. So the P&L will have both cash and credit transactions, not just cash transactions. Whereas here the sum effect of the way the cash flow statement is prepared, it translates everything into a cash movement. Because at the end of the day, cash becomes very, very important. Because what will happen is in a P&L, you can show a profit, you can show everything, but profit is not equal to cash. Because if your money is stuck in receivables or your money is stuck in inventory, that is not cash. It can get converted to cash at a later date by either selling your products or collecting your money or whatever that is. But it is not yet cash. But the P&L captures cash as well as non-cash transactions. The other thing is you use accrual method of accounting. When we say accrual method, it is not, basically it means that it is not cash method of transactions, cash method of accounting, because it also takes into account, for example, you would have heard of this term called provisions. Provisions basically means amount is due, but you have not made the payment yet. Rent is due, rent has not been paid. So that means that you have not received the demand for the rent, let's say from your landlord. That doesn't mean that you don't have to pay the rent. It means that sooner or later the landlord is going to ask for it. So how do you reflect that? That's where you create something called a provision. Provision basically assumes that a certain liability is there. The invoice may not have come or the demand may not have come, but sooner or later it is coming. And it is important to show it in the books to show the real situation, financial situation of the company. So accrual basis of accounting takes that also into account. So that gets captured in the P&L. Whereas in a cash flow statement, it's pure cash. Only cash movement will get considered. It is a little more complex to understand, but I'll definitely try and make an effort to, unravel the mystery around this. But primarily, it is a summary of the cash receipts and payments. And it summarizes it for a period which is for a month or a quarter or a year. This is a sample of a cash flow statement. So we have on the one hand cash from, so there are 4 sections that you will notice over here. One is the cash from operations. The other one is cash from investing. The third one is cash flows from financing. So these are the three different types of cash flow transactions. It's just a category. These are three different categories. I'll come to the detail of what each actually means. But so please keep this in mind, very important. Cash flow from operations, cash flow from investing activities, cash flow from financing activities. So these are the three different types of activities that get captured. Then you have the opening cash that was there in the beginning of the year. Then the closing cash. And what is closing cash? You have the opening cash. Then you add the cash flow from operations. Then you add the cash flow from investments. Then you add the cash flow from financing operations. When you add all these things, that is what you get the cash at the end of the year. Now, some of it will be positive, some of it will be, some cash flows will be positive, some could be negative. But the effect of all that shows up at the cash as cash at the end of the year. So in this case, what has happened, if you see, beginning of the year, you had $4,396. End of the year, it became 4,138. That means cash actually came down.
Thanks.
Right? So if you see from where all it has come down, 19 cash from operations was a positive $19,000. But cash flow from investing, because you invested, your money actually went out. So cash actually came down. Cash flows from financing, cash flow, because we had to finance, we had to pay out certain amounts of money to maybe to the equity owners, or you had to pay off certain loans, etc. That's why we call it notes payable over here, or whatever that is. At the end of the day, what has really happened is from financing, there's a cash outflow. So you have an inflow from operations, outflow from investing operations, and the outflow, because brackets means negative, outflow from financing operations. So the net effect of these three was a negative 258. So opening balance, you had 4,396, and the cash flow from operations during the year came down by 258. Therefore, your cash at the end of the year became 4,138. 4,396 minus 258 is 4,138. Now, let me explain a little bit around what do we mean by cash from operations. Cash from operations is directly connected to the P&L. So you saw the P&L 22,484, right? So that income, that is the profit that we saw. But as I also mentioned to you, we take only the cash transactions. The non-cash or the credit is not considered for this purpose, because here you want to measure only cash movement. So what we do is we add back depreciation. Why do we add back depreciation? Depreciation is not a cash transaction. It is a notional expense that is put to revalue the asset. So, so we add it back, saying that it was considered in the P&L as an expense. 2051 was considered in the P&L as an expense. So, so your profit to that extent had come down in the P&L. But because it's a non-cash transactions, we are adding it back and saying, okay, this needs to be added back so that only cash is considered. Non-cash is not considered in the P&L. So you add back non-cash, then you have changes in working capital. Changes in working capital are basically the accounts receivable, payable, deferred revenue, taxes. So the way this portion is done, so the 22,484 comes straight from your income statement, as you can see. Depreciation is a non-cash item which was in the P&L, but you are adding it back. So you are increasing your profit to that extent. These items, receivable, payable, deferred, accrued taxes, etc., they are considered as changes in working capital. And the changes, how do you define the changes? How do you work out the changes? You basically consider 2 years of balance sheet. So the accounts received, the movement, the changes in the balance of the previous year to the current year is what is shown as movements in working capital. So change in the account balances in each of these as compared to the previous year is what this is. And the reason why this is done is to reflect cash. So if your accounts receivable was, let's say, 1,000 last year, this year it became 500. What does that mean? That means last year 1,000 was, you were supposed to get 1,000 from your customers, and you're waiting for it, waiting for it to get collected. This year it is 500, means you have collected 500. So to the extent of 500, cash has increased. So increase will show as a positive. If it is an opposite situation where it actually went up, accounts payable, accounts receivable actually went up, that means cash went out of the system. So the reverse happens. So in that case, that becomes a negative instead of a positive. Same principle applies to inventory. Inventory didn't get captured here, but inventory also should be captured here. So inventory, accounts payable, deferred revenue, the same principle applies. Compare last year with this year, and the difference is shown as a cash flow movement. So that is what shows up in the cash flow from operations. Cash flow from investing capital expenditure is very straightforward. This is basically, if you buy a machinery, you are going to pay money for it. This is what that is. And likewise, cash flow from financing is any transaction which is pertaining to financing activities like borrowings. So if you are paying off a working capital loan or a term loan, that is an outflow. If you are paying interest on the working capital loan, that's an outflow. So things like that. Or if the owner is withdrawing money from the company, then that is also an outflow. So those are the things that get captured over here. So that's the kind of explanation for each of these. And just one more slide kind of shows the connection between the balance sheet and the cash flow is over here. This is just a sample. So if you just see over here, changes, the numbers in the statement are in the cash flows are derived from the changes in a business's balance sheet accounts during the year as compared to the previous year. So this is how, so in all these cases you compare. So if you see the first line over here, if you can see my pointer, balance sheet changes from 2006 to 2007. So these are actually the changes. So these changes get reflected. So accounts receivable change, the difference between the last year and the current year, that gets shown in the accounts receivable increase, as we saw in the previous one, in the cash flow from operations. So like that, all this inventory, prepaid expenses, all these things are derived from the balance sheet changes from the previous year to the current year. So this is how it is impacting each of the balance sheet items is impacting the cash flow. And one important point to note in this whole thing is to see, for example, if you can see over here, $5,76,000 is the total of cash flow from this $576,000 is actually cash flow from operating activities. Basically, what that means is you have generated cash out of running operations, which is a good situation. So when you read a cash flow statement, this is what you have to look out for. Is the cash increasing because you borrowed money, or the cash increased because you generated profit out of your operations? Borrowing money is not generating real cash. You have just borrowed. Someday you have to pay back. Generating cash from operations is very, very critical. So every year you have to watch out and see, when you do a cash flow statement for each year, is your cash profit increasing or not? If it is not increasing, it is a cause for concern. And that is exactly the reason why one needs to look at the cash flow statement to make sure that you don't get hoodwinked by the P&L. Oh, your accountant is saying, oh I'm making a profit, so I have money. Profit is not equal to money. Net profit in the P&L not equal to money, because your money is may be sitting in your accounts receivable. Unless you convert to cash, you have not received the money. And what if he doesn't pay up? That means you have to write off. That money is gone. So till it gets converted to cash and gets converted to bank account, converted to cash in the bank, you should not rest easy. That's why cash flow becomes very, very critical. Same thing with inventory. You may be making a profit, but that may be because you are sitting with a load of inventory sitting over there. The money sitting in inventory is of no use. It is useful, yes, for planning future production, sale, etc. But beyond a certain amount, a critical value or amount, it is a waste if your money is sitting in inventory. So those are the kind of things that get highlighted out of the cash flow, and it's very, very critical for the entrepreneurs to be looking at the cash flow statement. I think with that, I have come to the end of the presentation. So next Saturday, we'll be doing financial ratios. But before that, any questions you have? Anything? Any clarifications that you're looking for?
Shekhar, one question probably from my side, and is dealing with and talking to a lot of SMEs. One is on depreciation accounting, right? Like, for example, it's very important. And if you see that the SMEs in the Western and developed world, how do they account for depreciation? They actually they give a lot of importance to depreciation, right? Where they actually look at how their business is doing versus what we do here in India in terms of typical practices different. So just if you can touch upon very briefly on how one should actually look at depreciation, given that it is basically a money that you have spent and now you have to account for when you have to take important decisions like pricing decisions and some of the decision on acquiring new business, right? So like your take on what kind of importance that entrepreneurs should give while looking at depreciation.
So as far as depreciation is concerned, the accounting methodology for depreciation is pretty much similar to the international norms. Rates may vary a little bit depending on what the statutes say, but in concept, it is identical.
Okay.
So there is no difference there. So the way I would put it is, if somebody is not accounting for depreciation, that is incorrect. Because the rules are very clear, even in the Companies Act. The schedules in the Companies Act are very clear. The rates are also prescribed. So it has to be done. Otherwise, it is incorrect, and it can lead to problems. So there are two types of depreciation. One is the company depreciation, which is defined by the Companies Act.
Right.
The other one is the tax depreciation. So while in the books of the company, as per Companies Act, there is a way in which this has to be reflected at certain rates, which are recommended. The tax rates tend to be different, so that gets accounted separately. There is a different accounting methodology for that, but tax gets, because sometimes what happens is, as per tax, you are supposed to, let's say, charge a higher rate of depreciation. So that gets captured separately and gets included in the financials. So both have to be considered. And from your question, from a pricing perspective, the pricing has to be derived from the P&L, and the cost sheet also has to be derived from the P&L. The P&L itself will have the depreciation. So if you have been accounting depreciation properly in the P&L, and thereafter you are doing your cost sheet, that means for pricing, it's a pricing or costing sheet. And if your source is the P&L, then you are good. You're safe because you have already considered depreciation because it's already part of the P&L. But if you are not accounting for depreciation correctly and you are under accounting for depreciation, basically what happens is you will be under recovering from the customer because you are thinking that expense is not there.
Okay.
The reality is that is a real expense, because let's say in 5 to 10 years time, that machinery is going to be defunct. And to that extent, over the 10 years, if you have not recovered and charged to the customer that expense or that cost, then effectively what you're doing is you have under recovered from the customer, and theoretically, all other things being the same, what it basically means, you will not have money to replace the machine.
Right.
Because you never got it in the first place. You didn't pay, you didn't collect the money for it. You didn't charge your customer for it. Because it's a real cost. It's a cost of doing business.
Clear.
Yeah.
Okay.
Any other questions?
Yeah, I have not a question. I have put a small quiz. Participants,
sure.
regarding the topic shared. A very 4-question small quiz. So
very. These are thanks for reminding. These are very small and simple questions. Nothing very complex. So if you can just take a few minutes to quickly do the quiz, it'll be great.
Yeah. Meanwhile, if you have any other questions, Shekhar would be happy to take them.
We've also given you a link to the Vadhani platform, the web app, and you can connect with Shekhar over there as well. Please feel free to log in and connect there.
Shekhar, one probably question again from benefit of all, right? If like again taking a clue from what you mentioned, basically like for pricing decision, I have to look at my P&L, right? So different business decisions that entrepreneurs have to take, right? Or which of the 3 financial statements will actually help them? Like if you have to take this and link it to a real world decision making process, like for pricing, you look into P&L. Now, similarly, what all decision that you can actually make by looking at P&L, balance sheet, and cash flow?
Sure. Yeah. So by looking at the cash flow, for example, let me just focus a little bit on the cash flow. The cash flow position will basically tell you whether, in fact, for that purpose, we may have to do a little bit of business planning and forecasting also. But even when we do the planning and forecasting, what one does is, which I'll come to in one of the later sessions. But what basically happens over there is you do a projection, you do a projected P&L, a projected balance sheet, and a projected cash flow. So when you do a projection like that, it kind of tells you and that is based on certain assumptions, business assumptions. So when you do that, it kind of tells you whether you have adequate cash for the business or not. Because it will clearly tell you the way the assumptions you have taken and how the business is moving, how the market is moving, the demand for the products in the market, competition, all those things. Taking all that into account, when you do a cash flow, you find, let's say your cash flow from operating activities is negative, then you have a problem. Then you have a business decision to take. That is a very big decision to make. Am I pricing correctly or not? Is there a problem? Why am I not getting? Is it so cash flow from activities? Is it because of working capital management related issues? Or is it a pricing related issue? So all those will actually come out of the cash flow statement. So if for that, so that is one way of, so that is more about how you price your products, what kind of cost reductions you need to do at the manufacturing floor, or in terms of purchasing your raw material, etc. You have to start working backwards from here and say, to make this positive cash flow from operations, what do I need to do? So then you start answering questions like, can I increase the pricing? Can I increase the volumes? So that is one angle to improving the cash flow. The other angle to improve the cash flow is my money stuck in receivables? Are there old aged inventory items that I need to collect? Can I put some priority on it and go collect those items, those amounts overdue? So those decisions also need to be taken. That is more from an operational performance. Now let's come to investing activities. To grow the business, you may feel that I need to buy additional machinery. That's a decision point again. Do I have money to pay for it? Then the question is, if I don't have the money, where do I get it from?
Yeah.
Where do I get it from? That is a decision point. Then you have to go borrow. So you go to the bank, but the bank will say, the next decision point is, bank will say, hey, I'll give you the money provided you show that you are making profits. So you're back to the drawing board again. So this is exactly how P&L, balance sheet, cash flow line up. Because when you do this iterative process, it kind of tells you at which point you are actually going to start making money and show positive cash flow from operations. So many different things. Some are P&L related actions like pricing, etc., because directly impact sales, cost, etc. Then there are a bunch of balance sheet related actions which are like collections of receivables, aged receivables, cleaning up aged inventory, getting rid of inventory, because both aged receivables and aged inventory are a drag on the cash flow. So the faster you convert that into cash is good for you. And that is where both the balance sheet, in fact, the cash flow actually comes out of the balance sheet, as you can see from here. So if you're looking at your balance sheet continuously, it will actually improve your cash flow also.